I'm Rick Plum with this week's Lucia Capital Group weekly video. If you're one of those people with a traditional pension plan, one thing you should know is that if you're married, your pension benefits are required to be paid out to you and your spouse in the form of what's called a Qualified Joint and Survivor Annuity, or QJSA for short. This means that unless your spouse elects to waive that form of payment in favor of something else, you'll receive a reduced amount during your lifetime, so that your spouse will get at least 50% of that amount if you happen to die first. But if you both elect instead to receive, say, a single life annuity, the monthly benefit to you while you're alive will likely be significantly larger, but the payments will stop at your death and not continue for surviving spouse. What we often see is that the pension plan participant who wants to maximize their monthly retirement income are often tempted to choose this single life annuity for this very reason, higher payments. The problem is that many of them are also concerned about providing an income for their spouse if they should die first. So what's a potential solution? One technique that may work for you is something called pension maximization. Take a husband and wife as an example, where the husband is the one with the pension. The way it works is like this. The husband elects, with his wife's consent, to waive the QJSA payment and receive his pension benefit instead as a single life annuity. Now, this is a larger amount, but it's for his life only. They then use that additional pension income to purchase life insurance on him, with the wife named as a beneficiary. If the husband dies first, the pension payments will stop, but his spouse will receive the life insurance death proceeds tax-free, which she can use to meet her needs. The idea here is that by coupling the larger pension payment with the purchase of a life insurance policy on the husband's life, both spouses in this example may be able to increase their total income during retirement while also providing for the wife's financial future if the husband dies first. If the wife passes away first, the husband can discontinue the life insurance and keep the higher income from his life-only pension. Or maybe the wife doesn't live that much longer than the husband, and in that case, the remaining death benefit would go to heirs. There are, of course, a number of factors to consider in this example, like, is the husband even insurable, or is he likely to outlive his spouse? Now, if not, pension maximization may not be a good strategy. And even if he is likely to outlive her, they may still want to get some insurance, just in case. Also, how much will the life insurance cost? Will it cost as much or more than the difference between the single life and joint life payment? Remember, the cut in benefits you'll get with the lower joint and survivor option is kind of like paying an insurance premium to allow the surviving spouse to continue to receive your pension benefits after you're gone. The larger the benefits under the single life annuity, the greater the income that will be required to pay the premiums for the life insurance policy. So there's a lot to think about here. The pension maximization technique is not for everyone, but it's something you should consider as you evaluate your pension benefit options. And it's a good idea to start planning for it before you get to retirement age. Now, if you want to know if this technique works for you, just give us a call. We do these things every single day at Lucia Capital Group, and as always, we're here to help.